Most people get into investing backwards. They download an app, they buy a few shares of an index fund or a trending stock, then they pray the chart goes up and to the right. Then a high-interest environment hits, or inflation spikes. Suddenly their safe portfolio drops 25%. Here is the truth. Investing without understanding macroeconomics is just gambling with extra steps. Stick around until segment 3 of this video. I am going to reveal the exact 3-step Macro Allocation Framework. Institutional asset managers use this same lens. They shift capital before the market moves. They do not panic after the crash. Today we are rewiring how you look at money. We are covering why economics dictates stock performance, how central bank liquidity actually rules your net worth, and how you can position yourself ahead of the next economic shift. This is educational, not financial advice. Let us dive in. Let us start with a classic mistake. Legendary value investor Benjamin Graham wrote The Intelligent Investor. He taught us to look at cash flows, earnings reports, and balance sheets. That is microeconomics. And micro is great, until macro rolls in like a tsunami. It wipes out the whole beach. Think about 2022. You could have owned a company with flawless balance sheets, zero debt, and growing revenue. The Federal Reserve executed the fastest interest rate hiking cycle in 40 years. Nearly every equity multiple compressed. The company did not change. The cost of capital did. When you understand macro, you realize individual stock picking is secondary. Many macro strategists argue the broad market environment drives most of an asset's movement. This plays out over a 3 to 5 year cycle. Central bank liquidity and inflation trends are usually the biggest drivers. Say you do not know where we are in the economic cycle. Picking a great stock is like picking the fastest sailboat in a hurricane. You are still getting blown off course. As promised, here is the secret sauce. The Macro Allocation Framework. Billionaire macro investors like Ray Dalio use a version of this. Dalio founded Bridgewater Associates. He also wrote Principles for Navigating Big Debt Crises. His approach has helped build resilient portfolios across centuries of economic shifts. Macro-first investors do not ask what stock to buy today. They ask 3 sequential questions instead. Step 1. Where are we in the debt cycle? Are we in a credit expansion phase or a deleveraging phase? In credit expansion, risk assets thrive. In deleveraging, cash flow and capital preservation win. Step 2. What is real liquidity doing? Is global central bank balance sheet expansion positive or negative? When central banks print, financial assets tend to inflate. When they shrink balance sheets, asset prices tend to deflate. This happens regardless of earnings. Step 3. Where is the liquidity premium flowing? Liquidity does not spread evenly. It flows into specific asset classes based on real yields. Real yields are nominal yields minus expected inflation. Say real yields turn negative. Capital tends to flee cash and long-term bonds. It moves into equities, real estate, and hard commodities. When you stack these 3 questions together, your asset allocation becomes much clearer. You stop chasing hype cycles. You start placing bets where macro liquidity is likely to flow. Now, quick pause. I want to ask you a direct question. I want you to be honest in the comments below. Have you ever bought a great stock based on awesome fundamentals? Did it bleed out anyway because the broader market was crashing? Drop a simple yes or no in the comments right now. Tell me which stock it was. I reply to as many as I can during the first 48 hours. Let us look at 2 historical anchors every investor should know. They show why macro carries so much weight. The Bretton Woods Agreement of 1944 and the 1981 Volcker rate shock. In 1944 at Bretton Woods, the global financial system pegged world currencies to the US dollar. The dollar itself was backed by gold. For nearly 3 decades, that system underpinned unprecedented global growth. But in 1971, when the US suspended gold convertibility, macro rules changed almost overnight. Investors who stayed in traditional 1960s bond portfolios struggled badly through 1970s stagflation. Fast forward to 1981. Federal Reserve Chair Paul Volcker pushed interest rates as high as 20% to break inflation. Investors who understood macro bought long-term treasury bonds with yields above 14%. This helps kick off a decades-long bull run in bonds and equities. Those who focused only on micro-level stock picking missed something huge. It was one of the biggest macro setups of the 20th century. Macro tells you when the tide is coming in or going out. Micro just tells you which boat has the prettiest paint job. So how do you actually use this starting today without getting a PhD in economics? You track 4 key macro indicators. Number 1, the US dollar index, or DXY. A surging dollar tightens global financial conditions. A weakening dollar acts as global monetary stimulus. Number 2, the 10-year Treasury real yield. That is the 10-year yield minus the break-even inflation rate. When real yields rise, risk assets tend to suffer. When they fall, risk assets tend to fly. Number 3, global M2 money supply growth. This tracks the net liquidity injected by global central banks. Number 4, the high-yield credit spread. This measures stress in corporate debt. When spreads widen, credit default risk tends to rise. Check these 4 metrics for just 15 minutes a week. You gain a macro compass most retail investors never build. Now you understand why macroeconomics should come before investing. There is a common trap worth knowing about. Many financial creators on YouTube suggest a simple plan. Just dollar cost average into the S and P 500 for 30 years. They say you are guaranteed to retire rich. That claim is oversimplified. In the coming macro regime, it may not hold up the way people expect. In our very next video, we are digging into the dollar cost averaging myth. We are going to break down historical 20-year stretches with flat real returns. Take 1966 to 1982 as an example. Passive dollar cost averaging generated negative real returns after inflation during that stretch, and we will look at what some investors did instead during those stretches. Make sure to hit that subscribe button. Turn on notification bells too. Then you will not miss that breakdown. I will see